Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is October 16th, 2020. S&P 500 closed at 3483. This is David Zarling. I'm here with Ian Hot Coffee McMillan, back from his little hiatus at the end of last week. Great to have you back, Ian. We've got the S&P 500. It almost feels like I closed my eyes last Friday. We were sitting at 3477, opened them up this Friday. We're at 3483. We moved nowhere this week, correct?
We did not, and it's good to be back. I feel like I could have, based on your last sentence, I feel like I could have taken another week off.
Yeah, you're right. Yeah, just close your eyes, wake back up, and you're fine.
I don't even think
the markets didn't do anything this week.
I would say it was also one of the weeks recently we really didn't do too much in client portfolios.
Right.
I guess a couple tweaks here and there, but I mean, not a ton. I thought we were going to get some new information. I mean, we did get new information, but
and you could say,
also indecision,
right? If we're looking on a weekly time frame, we got something that's called a doji. I don't expect clients to understand or know what that is, but it's basically a price action for the week that communicates indecision overall for the broad market for whether we're looking at the S&P 500 or the NASDAQ, those types of things. For example, I mentioned last week we closed at 3477. This week we closed at 3483, but the market was as high as almost 3550 on the S&P 500 and gave all that back. So we had that gap up on Monday, but really nothing actionable during the week that anybody who manages money for a living could do anything with.
Yeah, short term, a lot of indecision. Like you said, Monday gap up, and we had a lot of potential. I think there's some disappointment from both sides this week with some potential for follow through. I'd say Monday and today were kind of disappointing, I would say, for bulls.
Right. And when
especially in looking at something like this, like the Russell 2000, it is a little fortunate to not see yesterday's candle get some oomph today.
The way I would describe this for those listening who might not necessarily understand what we're talking about with follow through, you just might have a day or a week where you see demand outpace supply on the buyer's side, so on the demand side of the equation, but then you don't see that follow through the next day or the next week. So there's almost like a failure to follow through with something. And so that's what he's talking about is, whether it's seeing demand outpace supply and follow through with that. For example, Russell 2000 on Thursday had a very nice, potentially reversal type price action. Where it looked like
especially
demand was
after a pretty bad open. I'm putting it in context of what's happened in 2020. We gapped lower. They bought stocks up all day. Normally, in any environment with conviction, you would have seen that follow through today and into the weekend, but did not happen. So,
well, in the markets, we know that, right? They're not quote unquote normal. Like they're uncertain, and it's for example, it's perfectly normal that where the Russell 2000 is right now, and we talked about 160 being important, that we're still sitting right below the gap from February. So that February 21st going into the 24th gap, we're sitting right below that. And so that's something that's an area that has to be worked through from a supply standpoint.
Looks like it's gone about halfway into the gap.
Right. Oh, half gap. Interesting.
How about that? So, it's one of those things where didn't see the follow through there, seeing some indecision broadly, in the NASDAQ 100, if we're using something like the Qs as an example of that as well, whether we have a close last week around 285 and this week 288, kind of in the same boat as the S&P 500, but yet there's still things percolating underneath where, yes, we have some indecision, and maybe you even have that on the sector level, but from sub industry, there's certain areas that are still showing strength. That
there are, and I mean, it's still for the most part pretty growthy.
I like that. Growthy. That's good.
Online retail, software, obviously home builders have maybe been the biggest thing that we've talked about, on here or on Twitter over the last 2 months. Those continue to be strong, and everything, again, and not just home builders, but everything that goes into building a house.
Right. Medical devices,
especially retail. In fact, I mean, lots of things tied to consumer discretionary and spending still very, very strong.
And that's not even in the US either. Like we're seeing even like Chinese consumer discretionary.
I was gonna say probably the most interesting theme to take shape recently, and so certainly it seems to be something bubbling there under the surface, is China. Discretionary Chinese financials actually had the best week of everything kind of in our ETF universe that we track. But yes, still growth. And over in China, for the most part, it's still discretionary and Chinese internet, cybersecurity, semiconductors. At the index, it's interesting, right? Because then at the index level, growth, or NASDAQ versus Russell 2000, kind of your two extremes, still nothing. I would say no definitive trend there, but small cap growth has been strong.
Well, and what's interesting about that is if you were just to look at numbers on a spreadsheet or compare what's the performance of the NASDAQ and what's the performance of the Russell 2000 since, let's call it the bottom near March 18th. I know we could also talk about March 24th, but they're basically neck and neck. At the same time, it hasn't been just a straight line. I think that's the beauty of using charts, is it gives you some context on what exactly is going on.
There's been multi-week runs between each. They've kind of just traded back and forth, which is the rotation, right? We talk about healthy rotation.
Right, lifeblood, right?
For my personal preference, me being greedy, I'd like for that rotation to be a little bit slower. But we don't get what we want always, especially in open, free public markets. So
yeah, it's true.
Not hasn't been nearly as much conviction in our client portfolios in regards to that. Coming out of this, obviously,
out of the March bottom,
a lot of conviction over towards growth in the NASDAQ, because that's what had led for 3 years. That's what ended up leading in March on the way down. That's what led coming out of this. For the most part, led coming out of this. But NASDAQ, and it hasn't been banks and it hasn't been biotech. So it's had to have been small cap growth.
Right. And you look at something like that, you look at small cap growth on a relative basis, and we can even touch base on that in the extended version.
Which is, all these packaged software name. We can find lots of those. Yeah.
Right. And so there's definitely different schools of fish underneath the water that are showing strength. And it's not quite as obvious when you have an indecision week like we had this week. But at the same time, if you look even broader, if you look at the monthly level, the monthly price action that we're seeing is perfectly normal. That's something you would expect when you had 5 or 6 months of straight up since March. To have a little bit of consolidation, perfectly healthy. October is still a positive month for the broad market overall. And we continue to be in that 6-month window where we see strong seasonality. And so,
and I think that's going back to something you touched on. I think that it's important to keep it in context that we are coming off a 70% rally over the last 6 months. I don't know if that's ever happened. I'm sure our friend Ryan Dietrich could help us out with that. But
yeah, and it's this combination, right? You've got a period of time where if we look to the side, look left and right, and we don't look at just the S&P 500, the NASDAQ, there's lots of things that have moved sideways for 2.5 years
We just came off a panic crash back in February and March. We've since rallied, like you said, for example, S&P 500, 60, 70%. To consolidate here for a little while, perfectly normal and healthy. And I know the news du jour, right, is the election. Everybody and grandma's talking to me about the election. Mom's talking to me about the election. Everybody
wants to know what's it going to mean for stocks if who wins.
Right. And no party, no president has a monopoly on market returns, right? Because we all have our biases. We all have our favorite candidate. And go ahead.
I wish my Associated Party dominated the market.
Right.
But they don't.
They don't, right? And that's the thing.
But neither is the guy on the other side. So
right. And that's the thing. Like, we know of contemporaries, meaning peers in the industry, who sat out the rally in 2017 because they thought a President Trump meant bad things for the market. You know what I mean? Like, and
I will say that those people were not technicians, though.
Right. Correct.
They were not. Correct. They were macro economic, theoretical, a lot of the stuff they like to say about Trump. Oh, don't give him, the nuclear briefcase. He'll press the red button at the first chance he gets. Blah blah blah.
I remember when that was a story. Yeah.
Well, and I think we'll go ahead.
No, I was just gonna say, part of being a technician, and it's the most wonderful thing, is you submit yourself to the market and price knowing more than you do. And that's contrary to a lot of our industry, which tends to focus on, am I right or wrong? Where we focus on, are we on the right side of the trade or are we on the wrong side of the trade? And so we're open to all outcomes, regardless of who like Ian and I both have our favorite candidate.
So you're going exactly where I was kind of hoping you would. And kind of that conversation that we had.
And anything can happen. One candidate can win and the market goes up, or the market goes down. The other candidate can win and the market goes up, or the market goes down. And many people in their minds have a preconceived notion that if their candidate wins, the market will do well. If their least favorite candidate or the other candidate wins, the market goes down. We don't live in that world. We live in reality. That's the world that other world is a bias world. The world we live in is the price world.
You touched on it earlier this week in a private conversation we had, in that, I mean, we're fully accepting that if the individual who we choose not to vote for is elected and markets just start ripping higher, you bet your bottom dollar I'm going to be participating in that.
Right. Exactly.
Like I don't get to sit to the side and say, no, price is wrong. This will eventually, roll over, or he's bad for the economy, or he's bad for Wall Street, or he's bad for, whatever. Both sides have their sticks that they like to poke at. You have to, right? We have 18 days for the election. You better start prepping your mindset now.
Right. Get your mind right. Any outcome is possible, regardless of who your candidate is.
Well, and I will say this, for all the people that, if Trump wins, the economy is going to crash, the market's going to crash. For all of the Trump supporters that have enjoyed mocking those comments over the last 4 years, just be prepared for the reverse to happen.
Right. Yeah. Right. We have an incumbent who's in an election period here where we get to vote. And that's the beauty of America, right? Well, first of all, let's be thankful that we get to vote. And like you said, it doesn't, like, whoever the candidate is, you probably have, those listening, you probably have something in your mind on the way things are going to look. And I'm going to guarantee you that it's not going to look the way you think.
Yeah.
Regardless of who that candidate.
We all have preconceived notions about what the country is what's going to start happening on November 4th.
Right. And the fact remains, we don't know.
No,
and that knows. And that is, besides "I love you," probably the most 3 important words you can combine.
Well,
appropriate
and
way
it's
to
not
say
a
it,
big
but
thing in our industry for, right? I mean, outside of, and this is probably true for a lot of industries of, what do you want to say, a majority white collar, of that I mean, putting your ego to the side is just not a very common thing.
well, in saying in our world, saying I don't know somehow conveys weakness, where I would
Mm-hmm.
argue that the submission of I don't know is actually a strength. So for
Well,
our team, saying I don't know and having an open mind and being able to pivot in that's an athletic move, right? That is something being athletic. It's nimble. When we say we don't know, that doesn't mean a lack of confidence. We're just saying we have no way to predict the future, but we're ready to react to whatever the present brings us.
well, I will say this of, let's say even your candidate of choice wins. Congrats. We get all right. So we're really getting into the season, and it's been coming hot and heavy the last week or two on, I'd say really even the last month or two, on if who went, what sectors or industries in the stock market benefit depending on who wins. And again, I want to take you guys back to 2016.
Yes.
And if Trump wins, it's going to be small caps, it's going to be financials, it's going to be energy, aerospace and defense, right? Because of course he was probably going to start 3 to 4 wars.
That's
So
right. Remember
Yeah.
that was the story.
That was the whole thing. Is like
That was the whole
he'll
story.
start his first 100 days he'll start a war. So why wouldn't you buy Northrop Grumman?
Right.
And so what have we seen over the last 4 years? What has outperformed? None of that. It has
Correct.
been tech. It has
Yes.
been discretionary. It has been a very growth-oriented environment. So they were completely wrong. Even when they get the candidate right? Because there's all this theorizing, and bless their hearts, these people have to come up with something. It's their job to put something down on pen and paper and give it to their editor. And so, but again, I mean, I remember that like it was yesterday, that they were adamant, energy, banks, aerospace, all of that. And none of it panned out.
Correct.
It did for 2 months. And then it went, as soon as
Sideways.
January 1st hit, it was right back into tech.
Right. And it was sideways. And it's one of those things where price has to dictate, right? Economic law, not theory, supply and demand, economic law has to dictate your process. And so regardless of who is elected or not elected, etc., you're exactly right. The things that were happening in 2016 did not come to fruition when you talk about the things that were quote unquote predicted at that time. And so you have to be
because
open.
Trump's very anti-big tech. So why wouldn't tech stocks underperform?
Right. That was the thinking at the time. And so you have to, the only way you get past the narrative and the fear that's peddled, and I'm going to come down a little bit harder.
Factories of fear. Entire factories.
Yeah. But that's our current view, is that the media is a fear factory.
It is. They all are.
They all are. And here's the interesting thing.
I envision factories with fear coming out the smokestacks.
Yeah. Just pumping, right? Just off the assembly line. Like, what can we feed these people that gets them afraid? Yeah. Or what can we, like, it's just crazy, because here's the thing. My youngest daughter, she's like, Dad, you know what I like? That even with all this stuff going on, we're still the United States, right? Like, there's been a lot of challenges over the past year, and we're still the United States. Now, how much of the challenges of the last year, and I'm not saying COVID's not something to be afraid of. I'm just saying that what the media chooses to focus on tends to drive clicks. And Ian and I are very familiar with this. If we tweet something that's because it's Perma Bear Awareness Week, that if you tweet something that's
green ribbons.
Right? Yes. If you write an article, or you tweet something, or you put something out that's negative about the market,
What's interesting is you will get like twice the.
Oh, I know for a fact that there are huge FinTwit accounts that do this because they have said so.
Right.
That
like
their engagement triples if they are more negative on the market and the economy.
Correct. So if you think about that, that's an immediate conflict of interest, both for those in the financial media and those in the just over everyday media or political media. Your readership, your viewership goes up the more you focus on fear and the negative. It's a weird, it's a human dynamic. It's a human nature dynamic.
Because if you always hear that everything's okay, you're just gonna go about like that doesn't get any eyeballs. You're gonna open up the paper and you see the headline, the world is utopia. Well, you're just gonna you're gonna right. That doesn't cause you to go into a panic and get online and start searching things and start worrying and start going down these rabbit holes and building ideas and theories up in your head about what's on the verge of happening.
Right. Like, so if you're someone who tends to tilt politically left, right, you're going to gravitate towards the negative news on the candidate who's on the right and in our industry, what's going to happen to the market there. Right. So all of a sudden, all these eyeballs are over there. Same thing on the flip side. You're someone from the right. And if someone from the left gets elected, all of a sudden, like, oh man, this is going to be just
this guy's
going
to be horrible for the economy.
Right. And we'll go back. The data shows that neither party has a monopoly on the returns of the market, period. Now, I'm not saying that you should just go vote willy-nilly. Vote your principles, vote your values. I don't have a problem with that. What we're saying is that your biases take you towards this fear factor. And I'm actually kind of upset with the media. I'm very frustrated with the lack of factual reporting. All the articles.
Oh, you're upset with the media. That's so different than from your normal stance,
yes,
David.
Yes, please. Maybe we'll have a podcast where I'm pleased with the media. But until that, here's the deal. So, and I keep coming back to this. Our team as fiduciaries has to operate in the best interest of our clients. I know this, that the media is not in that same avenue. They're not required to work in the best interest of their listener, their reader, their viewer. They are in the interest of increasing eyeballs, increasing clicks, because you are the person they are selling to. That's how they get their commercials for the razor blades, for shaving your face, or selling you the latest car or the latest phone, is if they can increase viewership. So there's an immediate conflict of interest. And we're supposed to, you and I are supposed to work in the opposite of the conflict of interest. And so that's where I struggle, is we have a media enterprise that is based on driving eyeballs, driving ears, and driving, everything is based on increasing clicks and all those things. And that's not necessarily in the best interest of the person who's consuming those things. And that's where
I will say this. While all of that is true, I have never really experienced a group of clients like we have that do truly understand that. I believe a majority of them.
As far as
understanding that we aren't going to be beholden to what is being thrown out on newspaper stands.
Right. Yes. We have very well educated clients that understand the biases that exist. For sure. And again, I know I come down on the media pretty hard, and it's only because I get sick and tired of like the fear factory portion of it, where everything is dramatized and everything is increased just to increase viewership and all those different things, where maybe if we just presented the facts and let people, make their own opinions about things, we'd be better off. But I don't want to get too far on that tangent. One thing that I kind of want to, if I'm allowed to pivot, move to that we're going to talk.
I'll allow it.
You allow it? Okay.
Yeah,
awesome.
I'll allow it.
Awesome. I appreciate that. We're going to go into more detail in the extended version. I want to talk about this term alpha. So
Alpha.
alpha
Oh.
is shop talk term. It is something used in our
Alpha.
industry. What is alpha?
Alpha, I would say, is your performance relative to a benchmark. So I mean, you can have positive or negative alpha, but alpha in sense would be your outperformance versus some type of underlying, benchmark.
Right. And that can be based on your
Lots of ways to measure it.
Right. There's lots of ways to measure a benchmark. So that first you start there with your benchmark, and then you look at your performance versus that benchmark, right? Because for some people, there's certain benchmarks that are appropriate for them. And so I'm going to use, for example, a benchmark of the S&P 500 that's very aggressive. Many in the industry don't like to do that.
It is very aggressive for our industry. So if I can, though, just for the sake of keeping it simple and explaining it to someone who might be new to the concept, what is alpha when using the S&P 500 as the benchmark? So if, let's say the S&P is up 5% and an investment model or a portfolio is up 7%, then you would have 2% alpha.
Perfect. And so that's something we focus on as part of the Adaptiv team for our clients all the time, because our view is we're not in the market to make friends, not in the market to have fun. We're in the market to make money, also protect money.
And protect money.
Right, and protect money. And so alpha, this difference between the benchmark and how you're performing, is an important concept that I think we're going to spend a little bit more time digging into in the extended portion. And so we'll leave that as a teaser there, and we'll pick that back up after this quick break here. But anything you want to touch base on before we wrap up this client portion, head on to the extended portion?
We've got 2 weeks before the election, and I think anything under the sun could happen leading up to those. We could rip higher, we could rip lower, we could do nothing. So at the end of the day, as always, it's still all about price. And let's see, the second thing is that I will be visiting next week. So if you're going to the Lunch and Learn on Wednesday, I hope to see you there and stop by and say hello.
Yeah, that'd be awesome. We're looking forward to having you over here. It's always a good time. It's always a good event, good education, good food. It's a way for us to reach out and educate. It's a great time. So hope those listening can make it. As far as our clients go, for all those listening who may not be a client yet, you can always change that situation. But as far as the way this week goes, we hope you guys have a great weekend, a great week ahead. Don't let the election cycle stress you out. Use price instead. Focus on those. And if you want, stay tuned.
We're above 3,400. We're still above the June or the February highs.
Right.
Nothing too dramatic yet.
Right. Exactly. A little bit of indecision this week above the February highs. Important. We've talked about 3,420 a billion times, not a billion. Mm-hmm. I'm exaggerating, but we've talked about it plenty of times. Still above their important level. So until next week, otherwise stay on for the extended version. Thanks for listening.
Have a great weekend, everyone.
All right, Ian, heading into the extended portion here, one of my really good friends texted me today and said, "What's the nickname for today?" And I thought that was really an astute observation that, every week you get a new nickname. Hot coffee this week. I mean, hot coffee, who doesn't like it?
I don't.
Same here.
I've never spent $1 at Starbucks in my life.
Ooh, I can't say that I haven't spent $1, but I can say
after like the first 3 or 4 years of simply just not being a Starbucks thing, then it became more of like, I'm going to carry this badge with me throughout life.
Oh yeah, I see what you're doing. I see what you're saying. What you're saying.
It didn't start off as like, oh, I'm anti-Starbucks, but now I'm like, yeah, Starbucks. I'm an energy drink guy, so definitely not. I'm not anti-caffeine. You can ask
Oh
my
no, we're
wife
not.
that.
Yeah, we're not anti-caffeine,
But-
but we're anti-hot coffee. I mean, what says friendship better than getting together and burning our tongues on some hot coffee? Ian?
Yeah.
I mean, that seems to be the international language, right? Like hey, you want to get together for some coffee?
I
No,
Also,
no, I don't.
I think that, yeah, I don't. I think that's one of the worst, like, right? When I was back in, like, the days of, like, having to meet with, like, fund reps and stuff.
Yeah, you want to get together for some coffee? No.
No, I don't. And hear
No,
about my large cap growth closet
Yeah,
index
yeah,
growth fund?
Yeah,
No.
please tell me about your large cap growth fund, and let's have some
That's
coffee.
really like a closet index.
Yeah, right. And
It's like 8:30 in the morning. Like, dude, no.
no. Now, if we want to get together over brewski, fine.
Briskies, alpha brewskis.
Alpha brewskis. Let's go there. So we kind of talked about alpha. We described what that was a little bit based off a benchmark in the first segment. Let's touch base on alpha a little bit more as far as it involves the adaptive process, the importance of alpha.
The importance of alpha, I think, is a lot different from a lot of people in the industry, both institutional and retail.
Yeah, what do you mean by that? When you say our view of alpha might be a little bit different than...
I think that, well, here's a good place to start, is one of the more common pieces that you'll hear, and I've heard, everyone has, is that, you don't trade your P&L, which
so that stands for profit and loss. If you haven't heard that term,
losses, and that if you just focus on your process, and now you also have to have a
bona fide
profitable process, that over the long term you will make money and your process will take care of itself, and you don't need to worry about the intraday or day-to-day fluctuations of what's happening. And I do, in some regards, agree with that. And I do also think that that's the appropriate mindset for 99% of traders and investors. It's just not really how we're mentally wired.
Yeah, as far as our process goes.
Yeah, and I think it's more about measuring versus, right, this isn't, I mean, we're not, again, how we have said many, many times, we are trading at the close. So this is not, trying to be overweight tech at 10 a.m. and back to overweight financials at
right.
11:30.
We're not sitting there scalping. We're not sitting there running
to do with
intraday
scalping or anything like that. It's more about, well, let me back up here. So we do know our P&L at any given moment on any given day. We know how our model's performing against their benchmarks, not on an end-of-day basis, which we know lots of performance gets updated end of day, or that's when a lot of PMs look at things, or they look at it the next morning. So we truly have what I like to say, it's a running scoreboard. Like, we're in a live game.
Yep.
The clock's running.
Yep.
And I know how we're matching up against our opponent. And I know why we're scoring, where we're scoring, who's scoring. And that doesn't mean, right, that could mean nothing on that particular day. But over the course of watching multiple, we'll call them games, you do begin to develop a sense of who, what, when, where, why.
Right.
How. Is the alpha coming, or why is the alpha not coming?
Where is the alpha coming from? Is it coming from selection, or is it coming from leverage? Or is it, and those are two good distinctions. One's not necessarily better than the other, but it's good to know, if we want to call it selection alpha, where is that alpha coming from?
Exactly.
And I think that's a really important. And so we can track that in multiple ways, whether it's just looking at a relative chart. So looking at something like BABA, so Alibaba versus S&P 500, right? We can look at a chart and we can see a trend of alpha in front of us, but also tracking it
if you want to call it numerically on a sheet, is also helpful. Confirming that process and understanding where laggards are, where performers are. I think it's an absolutely important part of the process. Completely agree.
Well, and I think it's for us when we talk about the top-down approach, and that is it's truly implemented in our models and portfolios of we're going from the indices all the way down to individual stock selection, at least in ultra growth and in as clients know in growth. We stop one step short, but we know what is costing us based on, are we, again, going back to, are you beating the market because you're 150% long and you're kind of just getting lucky and you're kind of able to wade in the waters, being overweight certain areas, but underneath the surface, kind of some of that leverage is overshadowing, we'll call it bad stock selection or bad, really, security selection, or bad, it can be bad weighting too.
Right.
So like lots of times it's just that things need to be tweaked. And I guess for me, I've never felt like right, and I know you're not a big fan of the predetermined return cycles, month to date, quarter to date, year to date, all these kind of the first of the month or the first of the year. And I'm with you on that. And so to look at performance on, I would honestly, even on like the end of the week, I think is almost too long.
Well, I
want
think
to know what players are costing me. I don't need to wait till halfway through the season to know what play, like why is he in the starting lineup?
Right. It's very, very much like watching, let's call it a football game. It gets very obvious when your offensive line is getting overpowered by the other team's defensive line.
Yeah.
You can watch a couple plays and be like, "Ooh, this might be, if we don't get this fixed, this is going to be trouble." And that's part of our process, right? That's part of that ongoing tracking of where is the alpha coming from. And if something isn't performing, we're pretty unemotional about it. I mean, if you can't.
And we're breakout, like, right? So especially in the individual stock selection, we are looking for new highs. And there are environments where breakouts are just clicking. And there are times when you are going to get a lot of failures.
Well, and that goes back to the charting process too, right? Like it's one thing to say you're breaking out on an absolute basis. It's another thing to say you're breaking out on a relative basis, right? Relative to your benchmark, relative to the thing you're tracking. That puts you potentially in the best position possible, right? If you're taking something that has had more demand than supply than historically that we've seen, whether it's an 8-week period or a 52-week period or all time. If you're breaking out on those time periods on a relative basis, that tends to put you in both a position where it increases the possibility of that type of alpha continuing, and B, just as important, I don't even want to put it as B, is managing that risk, that alpha risk, right? Because like you said, you could take that new position that put the potential of outperformance or alpha in your favor, but it also allows you to manage risk at the nearest point possible where quote unquote alpha could fail. And so you're right. The selection alpha is a huge thing. And as far as being able to track that on a day-to-day basis, that's important. It's like, it's like observing any type of game, football, baseball, whatever, and looking at an individual at bat, an individual and extrapolating from there.
Well, and I'd also say that it allows you to view where you're wrong and where you're right. So you prepped all week for the upcoming matchup and you were positive you were going to, your O-line, going back to your analogy, your O-line was going to dominate and you were going to be able to just run the ball up and down the field.
Right.
You get through the end of the first quarter and your running back has 17 rushes or, for 20 yards.
Right.
Well, that's clearly, we're not going to keep doing that for the next 3 quarters, right? Or you would think not. Yeah,
you at least at minimum you're making halftime adjustments.
So and there's ways to find out. Again, going back to what you said, am I on the right? Is it the sectors? Is it the sub-industries? Is it the stocks? Is it my weightings? Am I in financials, which seems to be right? but I'm in insurance when I should be in banks.
Right.
So it's those types of things where
It's a top-down
I think
approach.
we're constantly monitoring where we're wrong
Yes.
and making adjustments, or where we're right and adding to that.
Correct. Where the alpha is
There's
showing
nothing
itself.
with being right and continuously being right and throwing more shekels in that pot.
Correct. The more you're on the right side of the trade, the better off you are. And so there's nothing wrong with saying, you know what, if our offensive line isn't able to get to the second level and block linebackers,
We're going to have to throw the ball.
we're going to have to throw the ball. We might have to keep one more guy in and do our thing. And that's just called making adjustments. And so I completely agree with you. And that's it's an important aspect of our process to be able to track where is the alpha coming from on an ongoing basis.
And then going back to what you had mentioned is how we measure selection alpha. So again, it's not just being overweight, right? I'm overweight in something that's underperforming, but I own enough of it where I'm beating my benchmark. And that's not really winning in our book.
Right.
You need to, if you're going to be leveraged, you also need to be, if you're 130% long and your benchmark's the S&P, you need to be beating the S&P by more than 130%.
Right. More than 1.3. Yeah, exactly. Mm-hmm. Exactly.
You have to be.
Right. Because your selection.
Or else it's not worth it.
Right. Otherwise, the leverage risk isn't worth it. Completely. I agree with you.
And I think that a leverage can hide itself. It can hide it. It can trick you for a little bit, but eventually your ability to properly select the right areas to be in will need to be something you're consistently good at.
Right. And that's the beauty of charts, right? Because it's one thing to get, because we have no problem with using leverage to generate alpha. But if that leverage isn't generating the alpha that is the risk that's taken on to generate that, then you're taking on more risk than you need to.
Well, yeah. I mean, I could be 400% long banks this year, and maybe I'm beating the market, but what does that do?
Right. No, you're exactly right. And so that's why we track it ongoing. That's why we use a relative strength analysis, and whether we're tracking it on a chart, because the chart's the chart, right? Like each chart's taken on its own merit, but it's also important to identify on a day-to-day basis, where is that alpha coming from, and making sure that if something is lagging in that respect, we don't need to be involved in that. So kind of to that tone or related to that or segueing to that, what type of relative strength are we seeing among sectors? That kind of ties into alpha.
Sectors.
There's some things, we've for a long time, we talked about growth. We've talked about tech. A few moments ago, we talked about each chart must stand on its own merit.
Mm-hmm.
Can we talk a little bit about rates, like what we're seeing from rates, and then what we're seeing from financials? You know what I mean by saying that?
I think in regards to relative strength, it's still growth. It's still tech and discretionary.
Right.
Financials. Yeah, and I want to say someone had a chart this week of a relative relationship between XLF and the S&P, and then overlaid it with treasury rates. And that was there's a lot of correlation there.
Yeah. And there always has been. There's always has been some correlation, and it goes back to, is it rates first and then the stock performance in those areas second? Or is this, because many people
see the rate rise coming.
Right. Because I understand, and I'm not going to sit here and argue that somehow the equity market knows more than the bond market. But I do know that the common mantra on the street is that the bond market or the credit markets know more than the equity market.
Smart.
Right.
A lot more money thrown around there too.
Right. And
Don't forget how big fixed income market is compared to stocks.
absolutely. And that's absolutely
It's
correct.
massive.
Right. And I'm not here to say one area is smarter than the other. I just know that a common mantra is this, that the credit market knows more than the equity market. And that may actually be. All I'm saying is that we're seeing there are times where in the near term, I'm not talking about the long term, in the near term, we're seeing where we might see treasuries sell off, right? So rates go up.
Yeah.
Right. But that typically would be a tailwind for financials, and they're holding up. So does that mean that we now see a return of lower rates? It could. And that's where it goes back to, I think you have to take each chart on its own merit, right? So if we look at like FVX, which is the treasury yield of five-year yield, that tends to be a leader for the overall curve. When we look out, whether we're looking at 10 years or we're looking at 30 years for those type of rates, right? We look at that. We look at 30 years. We look at those type of rates. That can have a different outcome in the near term than financials and banks. It just can. And sometimes it can be confounding to see, oh, wait a minute, rates are up, but yeah, we're seeing regional banks struggle. But that might just be near term. It's not the long term. Like, as you alluded to, the long term correlation is higher rates is a tailwind for financials.
For banks and thus financials, yep, and small caps.
Yeah. And so maybe we see that, maybe we don't. You know, if I look at something like the 5-year rate, I mean, we're at the same level as we were back in April.
Yeah, and I mean, looking at TLT, TLT hasn't done anything in 6.5 months.
Right. You know, we're talking back to
now.
levels.
I would say it's kind of starting. If we're gonna get, I will say this: if we're gonna get higher rates, now is a better chance to do it than ever. This will be great information if they somehow cannot push rates higher here.
Yeah, if
they're set up to do it.
Right. If we were looking at something like TYX, the 30-year Treasury bond yield, if we're above 1.68, I mean, that's what. So now,
that's how. I mean, we got up there in June and then failed.
If we're above there, though, like, this is classic.
But then do you get into 1.90?
Yeah,
this is gonna be. It's not. I'll tell you, if they move higher, it's gonna be. Or I can't say it's gonna be because I don't know. But I would like to think it's gonna be a choppy, weird trend higher.
Well, and here's the deal. We know, because we're market historians, that rates move in about 35-year cycles. So for many of the people listening,
big cycles.
It is, right? So we're talking about early 80s.
Yeah.
And that's a long cycle. And it's not like those reverse overnight.
No, gosh, no.
It's typically a process.
I mean, you could have. I mean, that's a multi-year tops and bases.
Correct. So it's not like we get to sit here and say, "Oh, this is like the March bottom in equities. This is what we're going to see in yields or rates for 30 years." Maybe that's the lower probability outcome. All I know is that if we're above a 1.6 yield on 30-year treasuries, that tends to lead to the credence that we have higher rates on our hands. At the same time, on the bottom of the range, let's call it 1.2. We could be bouncing between those two levels for who knows how long, to build a base to build off of. And then that brings back, that pivots to the whole rate of change, right? What is the rate of change of yields? Because that also has an impact on equities, banks, financials, those type of things. That if we're in a range between 1.2 and 1.6 on 30-year yields, that's a low rate of change that could be very productive towards higher equity prices overall, because you don't have this the way I would describe it is like changing the rules of monopoly, right? If you have rates that are static sitting in a range, that tends to be
well, and it's easier for companies to predict what their expenses are going to be, like they're paying, like it's a much more stable environment to go out and we're like, I mean, I don't like in the secondary fixed income market, but and I'm not a market maker for corporate bonds, but I
thought that's what you did on the weekends.
Well, I've sent out a couple applications, but no one calls me back. So me and my wife made our own market. No, we're not.
the Macmillan market?
Yeah,
there's a Macmillan market. I got it.
Yeah, we have our own corporate. We have our own high yield corporate bond index. But what I'm saying here is, if it's more predictable, if corporations know what
they're paying for their debt,
they're going to be right what those expenses are going to be from paying interest.
Exactly. So we don't sit here and pretend to know the direction of rates or treasuries. All we know is on the high side of the range, 1.6 treasury yield, or on the bottom side of the range, 1.2.
Rates above 1.6. Let's get on the phone and talk about banks and financials. Right. Below that, we'll see.
Exactly.
There's also the theory that, I mean, you know, the quote unquote, the rest of the world has already gone to negative rates. Will the U.S. be the only country that doesn't? I don't know. We'll see. I'll let you know in a decade how this all pans out.
Yeah, exactly. As we start bumping up towards the end of our podcast, I kind of want to touch base on the importance of postseason baseball.
It is extremely important.
And so we have a scenario of relative strength on our hands of the Braves versus the Dodgers. Right, we got the Braves up 3-0. There's a trend there. Postseason trend, actually. Oh, wait. 3-1. There's actually a reversion of the mean, right?
There was a 9-inning quick pop, failed.
Yeah. Well, it was just a reversion, right? Because we all know the Dodgers have offense. And so, you know, in game 3, was it game 3? That Dodgers come out of game 4, Dodgers come out of the gates and throw up some runs.
Yeah, because we were up 2-0, then 2-1, now 3-1. Yeah.
Yeah. So
game 3.
So now we're sitting at the potential of the Braves taking control tonight. We'll see. But what we got going on here? I mean, I'm seeing some relative strength out of Freddie Freeman. What is the secret?
I mean, it's been a great series.
I mean, they haven't been there since 47.
99. Well, yeah. So I guess last time we were in the World Series was 99. Last time we won, last time we were in the NLCS was 2001.
So this is awesome.
It's great. I mean, as a Braves fan since I was extremely young. In fact, I would say the Braves were probably the first team I was actually the most passionate about. Like truly, like.
You mean as far as like all sports?
All sports, everything. Probably the Braves, and that goes back to my grandpa. But that
your grandpa was Greg Maddux.
So my grandpa was Greg Maddox's brother.
I believe it. I believe it.
He was, yeah.
I believe he controlled the strike zone like him.
And yeah, so I mean, other than 95, but then I was 8 years old, and being an adult and having appreciation for other adults who are working to accomplish. It's different when you're older. I don't know. There's a lot more factors and it was the same with the Chiefs last year. I appreciated being able to experience that later in my life in a weird way, and I do think it gave me more respect and more just
Well, there's a lot of things that have to go right.
overall appreciation for what it takes to win a championship.
Right, because you could be good, but if you're not healthy, right? So if people are getting injured, that right. So there's that. We all know there's a thing about the ball bouncing. So there's a thing of chance.
Yeah. Man.
And so just watching, the Braves succeed is pretty awesome. I mean,
especially in this unique season. And I think it was who was the old Red Sox manager when they were there?
Oh man.
When they were the bald guy.
Oh, did he also used to coach the Cubs? Are you talking about like? Oh no! I think I'm thinking of Don Zimmer, but I think, oh
man, no, not Zimmer.
I know. I can.
Terry Francona.
Okay.
He said that he thought whoever won the World Series this year, it would be the most difficult World Series to win. Has gone on, and I can see an argument in that.
Well, okay, and I completely agree with that because in baseball to ramp up, right? Okay, so
baseball's the most fickle sport as it is.
Well, and to ramp up an arm, right? To ramp up a pitching arm, it's not something you do overnight. Then, if you think about on the offensive side, you have guys that can just roll out of bed and swing a bat and hit a baseball. There's that type of guy.
Yeah.
And then there's the type of guy that needs to get in the cage and hit 1,000 outside balls off a tee. Or
where they really need spring training to
they're a finesse guy.
Mm-hmm.
And so I completely agree with that sentiment that you just don't like all of a sudden roll out of bed and, I'm going to pitch 100 pitches and I'm going to throw 3 different types of pitches. And I'm going to keep my velocity that somehow in a 60-game season that you're just going to, boom, that happens. I completely agree with that. And so it's a unique situation.
When I was coming up through the farm system, I was more of a finesse guy.
Yeah, I know. I saw you in the cage. You're able to hit the
I needed
outside.
to hop in the cage, get some hacks in.
For real.
Blow off some steam. Really about, February, March. Yep. For me as a player, it would have been hard for me to hop back in, like AAA baseball or something like that this year, just knowing how my body operates mentally.
Yeah. Well, my curveball only works in the humidity, man. So it's not
mentioned that. Yeah, I've seen you throw. I've seen you throw in different elements, and
you got to have the humidity of July in order to let that thing drop off the table.
Yeah.
And so
trying to get a little bit of extra pizzazz on that.
Yeah. So if you don't have July, I mean, I don't know what you do.
You got to have a little brim sweat.
Yeah. Got throw a little bit extra on the ball. I mean, if they're gonna hide those seams on me, tuck them under, reverse seam the ball on me, I better put a little extra on there. So one thing before we go, and we were kind of talking about this before we hopped on here, that I found fascinating, and someone can check us on this. You were telling me something about the starting rotation that I found for the Braves, the starting rotation, for those who maybe don't follow American baseball, typically you run a 5-man rotation, and that's what you start the season with. Where are you guys at now in this postseason with your rotation?
So I think we have two of our 5 opening day, or what was projected. I think we lost Soroka technically before opening day, but it's just Max Fried. I think we're down to one of our original 5 starting rotation pitchers left.
And I think that's incredible because I think that's the exception, meaning you might lose your 5th or 4th and there's some type of movement in the organization to fill that 5th and 4th spot on the starting rotation. But to be down to just 1, that's pretty scrappy.
Well, we got no Soroka, no Cole Hamels,
Cole
who
Hamels. Wow.
also, I think he started one game. Yeah, made one start this year for the Braves before he was out, which was an off-season move.
Right.
So we've had to, I mean, it has been a massive smorgasbord ragtag group of guys from AA, AAA out of the bullpen. In fact, tonight, AJ Minter will be the first pitcher in Major League Baseball history to make his first Major League start in the playoffs. So, I mean, they're pulling guys out. I mean, if they brought the bat boy out there to throw a couple across the plate, I wouldn't be surprised. I think.
Wait a minute. Is that, should I have not ignored that phone call? Were they calling me? Was that?
They could have been.
Man.
But it's been awesome to watch. We know the offense is there. We know the offense could do a lot for the Braves this year. But to see some of these other guys come through and step up in what's going again against probably the best offense in the majors and the Dodgers.
The Bombers.
Awesome.
Let's call them the Bombers.
They're incredible.
Los Angeles Bombers. Those guys.
The Los Angeles launch angles.
Yeah, incredible. So yeah, if they can pull that out, that'd be incredible. Both great teams. And so we're, bumping up against their time. So Ian, I hope they pull it off. I hope that they're headed to the series and doing their thing. That'd be quite the year for you between the Chiefs and the Braves. That'd be pretty doggone awesome.
Yeah, and make up for a really crappy college football.
Yes. So we've covered a great deal today between what's going on with the market, talking about a little bit about selection alpha, talking a little bit about hot coffee, terrible for you, and talking a little bit about the Braves, not a bad day. So with that, we want all you listeners to have a great weekend, great week ahead. Ignore the sensationalism out there. If you got to turn the TV off from the news, maybe ignore politics for a little while. With that, we want to wish you guys well. We thank you for the listenership. So you guys have a great week ahead, and we'll do it again next Friday.
Have a great weekend, everyone.